Welcome to Candlelight, where price is a mechanical function. In this video, I'm going to be going over what a price curve is and how to identify it. Now, for all you beginners out there trying to understand more about technical analysis and get a better feel for price movement and price action, a price curve is uber helpful because it really helps you out with your bias, both on going long and going short, and on your exits and entries. And it doesn't matter what asset class or what you're looking at. You can be a short-term trader or a long-term investor. You still want to buy low and sell high and buy low. So the time frame does not matter. And it also does not matter what asset class you're looking at. You can be looking at cryptocurrency, futures, stocks, currencies, options. Doesn't matter, which is why I always say a chart is a chart is a chart, because all price moves off the exact same mechanics. It doesn't matter what you're looking at, it works the exact same way. So let's jump right into it. All right, I want to go ahead and start with basing, because basing really is a fantastic example or fantastic, price action showing, where price rallies from, creating demand, and where price falls from, creating supply, thus giving you your price curve. A price curve is essentially this. If you're low on the price curve, then that's where demand is, because anytime that price rallies, it has to rally from the bottom. And the only thing that makes price rally is demand. So that's where demand is. The lower you are on the price curve, the more or the higher the chance or the probability that price or demand will, come into the market, making price rally. Anytime you're high on the price curve, then that's where supply is, because supply makes price fall, and the only time you can fall is if you're high. So low on the price curve, that's where demand is. High on the price curve, that's where supply is. So right here, this is the origin of a rally. So that's where demand is. When price re-enters that demand or is low on the price curve, then demand exists there and price goes up. When you are higher on the price curve, in other words, in supply, then your bias should be either exiting your long trade that you made here and making profit, or going short because price is high on the curve, making price go down. So basing is just a fantastic example of, what happens when price is high on the price curve, i.e. in supply, or what happens when price is low on the price curve, i.e. in demand. When it's in supply, price falls. When it's in demand, price rallies. Another example over here is the origin of demand. Price goes up. That's where demand is. That's your standard on what low on the price curve is. From this point forward, because the leg that took you all the way up here started here, this is now the low part of the price curve. Once price starts to fall and gives you a small trend, a leg, and then a second leg, a high, low, lower high, and then lower low, that's the origin of supply, or the origin of a fall. So that's now the high point of your price curve. So when price then comes down into demand or is low on your price curve, you want to focus on buying or going long. When price goes high into your price curve, then you want to focus on shorting. Basing is just a fantastic example of, the extremes of the price curve and what happens when price is low on the curve and high on the curve. So how do you identify it? It works like this. This is a chart of the euro. This is a daily chart. This is a 240-minute chart, which is 4 hours, and this is a 60-minute chart, which is 60 minutes, an hour. And it's all representing the same euro, just on different time frames. And every candle represents, on a daily, 1 day, on a 240, a 4 hour, every candle represents 4 hours. Every candle on a 1 hour represents 1 hour. So what you do to identify where the price curve is, both the high side of the price curve and the low side of the price curve, or supply and demand, is anytime you have a trend, which here you have a low, a high, a higher low, and a higher high, that's a trend, and you put your trend line on. Let me make that bigger. Oh, move that one. So right here you have a small trend, and then price breaks. Supply is the only thing that can break an uptrend, because supply is the only thing that makes price go down. The origin of that leg, that big leg, that's supply. It was able to break a trend, so that's the high point of your price curve. Anytime price breaks a trend or a trend line, that's a fantastic area where price should be respecting, because it's going to be the origin of a curve. Then price continues to come down, and you have a high, low, a lower high, and a lower low. That's a downtrend. When price breaks that trend, then that's where demand is. And it's no coincidence that the supply zone that broke this small uptrend is the origin, or is the high of the price curve, and this demand zone that broke this downtrend is the low of the curve. So now you have the low area of demand. So this general area is where demand is going to be stronger. And this area of supply, which is the high of the curve, where supply is going to be stronger. The area in the middle, this bit, that's when you trend trade, but that's not what we're going to be talking about right now. What you really want to be focusing on having a strong bias is strong areas of larger time frame supply and demand. So if you get your supply zone and your demand zone, or the high of the price curve and the low of the price curve on your demand zone, then you want to start focusing on what to do when price enters those areas on smaller time frames, and how to execute a trade by syncing what you want to be seeing on your daily, your 240 minute, or your 120 minute, or 180 minute, and then also down to like 60 and 15 and 5 minutes, so on and so forth. But you want to have large time frame to small time frame. So your big moves will happen on the extremes, which is the high and the low. So let's just say after price came all the way back down and then it starts rallying, you now know that this is where you want this, really in essence buy. This is when and if price comes back down into this area, and it's in the process of doing so, this is where strong demand exists. So you want to be seeing a synchronization of good demand zones on smaller time frames when price enters your larger time frame demand zone, just like what happened here. Now I know price broke above. That's another conversation for another video. We're going to stay on topic here. But when price was rallying into supply, in other words, going high into the price curve, that's when you still want to start having a short bias. You really want to start focusing on shorting. So what should you see when, or what do you need to be looking for when price enters that supply zone? Because this uptrend could have continued going and broken supply and just continued the uptrend. That happens all the time. So what do you do? On your 240 minute, let me make these candles a bit bigger. Let's do this. This leg right here, this fall right here, is this fall on a 240. This fall right here on a daily is this fall right here on your 240. And then this fall right here on your daily is this fall right here on your 240. And I'm going to be going over 240s first and then a 60 minute. But what you want to be seeing, just as we've talked on a video on trends, you want to have a high, a low, a lower high, and a lower low, thus giving you a downtrend. And once you have a downtrend, then that's when you want to be shorting areas of supply. So just as you have a larger time frame price curve, the high of the curve is here, the low of the curve is here, you also have it here. When you're in an uptrend on your 240, you have a trend line right there. When price breaks that trend line, then the origin of that move to the downside is where you should be focusing on shorts, as it's now the high of your curve. When price is falling, it's low on your curve. You don't want to short low. You want to wait for price to re-enter an area of supply. And by this point, we still don't have this trend line yet. You want price to come back high into supply and high up into your curve for you to short again. Whenever it's rallying all the way back up, then this becomes the low of your curve on your 240 minute time frame. So this is now the high, it broke, you have a trend line. And as price is falling, that's not where you want to short. You want to short high. So you want to wait for price to come back up. And when it does, it's going to have to create a mini uptrend. So you still want to short an area of overwhelming supply, and that's high on the curve. When you do, price is going to give you a small uptrend. This is the demand zone that broke this small, let me make this a bit bigger, this 240-minute downtrend, this high, low, lower, high, lower, low. It broke above and then rallied. Now this is the low where price is probably going to bounce, but you really are expecting for price to break it, thus giving you a downtrend. So when you shorted, this supply zone, broke. No coincidence that you had a bit of a bounce in demand and then continued to make a lower low, now giving you a larger time frame downtrend. Now you have your high, your low, your lower high, your lower low. Now you're in a downtrend. Now you really want to be shorting. And then this supply zone now becomes the high of your price curve, because this is a supply zone that broke this uptrend. Those and then strong supply zones in those areas, or strong supply zones, are the ones that you want to be shorting, such as this one as well. Now you want to be waiting for price to come back up into supply and get high on your curve so you can short. So when price falls, you don't want to short then. You want to wait for price to rally into supply and then start to fall. So I know those are a lot of colors and a lot of lines, but the most important thing is once price breaks a trend line, such as this one, or once price breaks a trend line or a trend, the origin of that break, like right here, that's where you want to be focusing on shorting, because that becomes the high of the price curve, and the origin of the rally into an area of supply is going to be the low of your price curve. Now you have the high and the low, and then trends start taking place, which means lower lows and lower highs, and then lower lows again. So a fantastic example, for example, on this move right here, this area on a 240, you're already biased because you're in overwhelming or you're in large time frame supply, so you want to be focusing on shorting. This small leg to the downside, or like this fall on your 240-minute chart, right here, this was the break of the uptrend. So you're already falling. Here you have on a 60-minute, your time frame is going to be a bit smaller, where you have now your areas of supply, which is going to be high on your price curve, and the low of your price curve, which is going to be demand. You want to short when price rallies. Now, it didn't quite make it in there, but the point is made. This is the high of your price curve, because it's the origin of a large drop. And then when it rallies back up into supply, that becomes the low of your price curve. But then again, trends start taking effect, and that's what you want to be seeing when you're going short, is lower lows and lower highs. So at this point, let me just take you to the last leg where price really fell from. You're in overall demand. You've got your high on your 240-minute leg, which is this area right here. That's the high of this leg. So that's on this price curve, that's the high. And then this is the low. So that's where demand is. You want to sell in supply and buy in demand. So what you want to be seeing on your 60-minute is when price gives you a high, or a price curve, a high point in the price curve, which is going to be here, and this is going to be the low point because price fell from here and then rallied from here. This is where supply is, this is where demand is. In this area of supply, you want to be shorting smaller areas that are given to you after price re-enters those areas. And that's where you short. You short those areas of big falls. When price comes back in, you want to short high and then wait for price to break. So I hope that was helpful. I'll be seeing you guys on the next one.